This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, well, on to the final part of this chapter, and indeed a new part here, in terms of something we haven't previously seen when dealing with CGT for individuals, though the issue is as relevant for individuals as it is in terms of companies. The only difference being, of course, here in companies, we also have to deal with, as we've said all along through these chapters, with indexation allowance, whereas for individuals, the unindexed gain, as now we call it here in corporate tax, would be the gain figure. There is no indexation allowance, as we know, for individuals. So we're looking at assets damaged or lost or destroyed. Now, in terms of disposals, that's going to, as we know it in capital gains terms, be classified as either a part disposal or an absolute outright disposal. And whether there is a gain or indeed loss to compute in relation to the damage, the loss or destruction of the asset will also then be dependent upon whether there's any insurance proceeds or any compensation in relation to the damage done to the asset or the loss or destruction of that asset. So we deal firstly with damaged assets here. So if an asset is damaged and either compensation from whoever's damaged it or insurance money, we've insured, of course, a valuable asset, and those insurance proceeds may therefore come in. So if we have compensation or insurance money being received, then this will normally be treated as a part disposal of the asset. You know that if cash comes in, then that cash would seem to imply that a capital gain, albeit here on a part disposal basis, needs to be computed. And when dealing with a part disposal, the cost is calculated using our normal part disposal formula, the old A over A plus B calculation, where of course it has always been sale proceeds over sale proceeds plus value remaining. Now here it says the value of the part disposal. Well, that's normally sales proceeds. Here, of course, it's going to be either this compensation or insurance proceeds coming in off the insurance policy that we've had on this particular asset. So it's that cash coming in over that self-same figure of cash plus the value remaining, the market value of the remainder at the time of part disposal. So the damaged asset is clearly going to be worth a smaller amount than the undamaged asset. That will tell you what the market value of the damaged asset is. So let's have a little look at the situation, therefore, where insurance money is received. Then, if the insurance money is not used in restoring the asset, a normal part disposal arises. If we pocket the insurance proceeds, we keep that cash, we do not spend it on repairing the damage done to the asset, then we've got ourselves a chargeable disposal. It's a part disposal and a capital gain must be computed. And in this calculation, with the market value of the part retained equating to the value of the asset in its damaged condition. That's the value after the damage has been done to it. And to deal with that, we've got ourselves a little example 4 here. They're asking us to calculate the chargeable gain arising on the receipt of the insurance proceeds. Again, the first thing we look at is who's doing the disposing here. Who is the disposer of this asset, albeit here it's damage done to. But we're dealing with a company. Therefore, it's a corporate tax capital gains issue demanding indexation allowance be computed and be deducted, rather than dealing with an individual where there be no such calculation of indexation. Bought a painting on the 1st of April 2000 for £10,000. It was damaged on the 1st of May 18 when it was worth £50,000. After the damage, it was only worth £25,000. On the 1st of July 18, insurance proceeds of £30,000 were received. So there's the critical figure, insurance proceeds. Now the question is, do we put those proceeds into an immediate gains calculation when they are received? And that is answered by, what do you do with those proceeds? And what we've seen so far is, if they were not used to restore the painting, that would therefore represent a part disposal, and a gains calculation must be performed. Given, as we've said from our starting point, it is a corporate disposal that we're dealing with, so we need the indexation factor from when acquired, April 2000, all the way through to December 17, again, given that the insurance proceeds here were received on the 1st of July 18, that is a date that is later than December 17. So how do we go about calculating the gain? Well, the insurance proceeds. There's your sales proceeds, 30,000. They go in as your top line sales proceeds figure. And as it's always been with a part disposal, the problem is establishing an allowable cost. We know the total cost. The painting was bought for £10,000 here. In which case, we now need to multiply that £10,000 by, what are the sales proceeds? Well, we've used the insurance proceeds as that figure, 30,000. Over the self-same sales proceeds, the 30,000, plus the value remaining. That, of course, is the value of the painting after the damage was done. And then it was worth £25,000. So what I'd like you to do now, therefore, is, if you haven't already set the gains calculation up, put your proceeds in. That's the insurance proceeds of 30,000. Work out the allowable cost, compute the unindexed gain, pick up your indexation factor as provided, apply it to the allowable cost, and compute that chargeable gain. And then check through, please, the answer in the back and make sure that you're happy with that basic calculation. Okay, well, hopefully now there was no problem with your answer to example 4, but just to quickly look at it, what were the insurance proceeds? 30,000. What have we done with those insurance proceeds? We've pocketed those proceeds, we've kept them, and that therefore means that a part disposal has occurred and a gain needs to be computed. Usual rules, what was the cost of the asset, here the painting, when acquired? £10,000. Multiplied by those sales proceeds, over the sales proceeds plus the value remaining. Always a figure, of course, that must be provided to you. Work out the allowable cost, and that therefore will calculate here an unindexed gain. Now, had you dealt with an individual in this situation who had owned that painting and suffered the damage thereon, and then pocketed, had kept those insurance proceeds, then that would be it. It would be £24,545 as the chargeable gain. But of course, because it is a corporate disposal, indexation allowance is available, albeit only up to December 2017. Apply therefore the given indexation factor to the allowable cost, 5455 there, get your indexation, take it away, and you've got your chargeable gain. Now that gain arose at the point you received your insurance proceeds because you kept them. But of course, what may very well happen is that you don't want to keep it in its damaged form, and therefore you use the insurance proceeds to repair that damage. So let's go back to our note now and look at what happens in this situation. So back to part B in our note here. Insurance money is received, then what happens? The insurance money is fully used in restoring the asset. If the insurance money is fully used in restoring the asset, then an election is available to the taxpayer to have the proceeds deducted from the cost of the asset for a future calculation when that asset is eventually disposed of. You have deducted the proceeds from the cost of the asset, therefore a lower cost, a bigger gain will arise at that point in time, thereby deferring any gain when the insurance is received until such time as the asset itself albeit in its damaged form, is subsequently disposed of. Sorry, in its damaged, repaired form, when it is subsequently disposed of. So, we had to sort out, when dealing with damage done to an asset, insurance proceeds are received, what do we do with the proceeds? Do we keep them, therefore an immediate gain, you've got cash in your pocket, but it is a part disposal? Or what happens if you now apply those proceeds to the repair of the asset? That means you no longer have to take on a chargeable gain and be taxed on the gain when, of course, you have spent the money on repairing the asset. And it's that situation that we see here in example 5. Assuming Daisy Limited, again we're dealing with a corporate disposal of course, elects for the proceeds to be rolled over against the cost of the painting, calculate the base cost of the painting on a future disposal. So, again here, purchased a painting, 1st of April 2000, cost £10,000. The painting was damaged on the 1st of May 18, when it was worth £50,000. After the damage, this time, it was worth £40,000. On the 1st of July 18, insurance proceeds of £8,000 were received. All of the insurance proceeds were used to restore the painting. Right, how are we going to deal with this? Assuming Daisy elects for the proceeds to be rolled over against the cost of the painting, calculate the base cost of the painting on a future disposal. Now, what that has immediately told you is there is no chargeable gain to compute in July 2018 when those insurance proceeds were received, because they have been applied in the repair of the damage that was done to that asset. We've reinvested. So the company is elected to roll over the proceeds against the cost of the painting. So what was the original cost of the painting? It was £10,000. So our original cost, 10,000. What then were our proceeds? The insurance proceeds received, remember we roll over against this original cost, 8,000. That of course would then bring down the allowable cost to 2,000. But of course what will then happen when eventually, if eventually this asset is sold, we'll need to deduct the full allowable cost. If all of the insurance proceeds were used to restore the painting, now it may mean therefore that we spent not just the 8,000, we might have spent 9,000, 10,000, whatever it is, but we would also add in whatever those restoration costs were, those repair costs that we incurred, and whether that was the self-same 8,000 or a figure bigger than 8,000, whatever it is, we will add in those restoration costs to give us what then would be the overall allowable cost. That is only an issue, though, on the future disposal of that painting. At this point in time, we receive the proceeds of 8, we reinvest those proceeds, there is no immediate gain that arises. So, when dealing with damage, insurance proceeds received, what do you do with them? Do you pocket them, therefore immediate gain, computed on a part disposal basis, or do we reinvest them? In which case we are able to defer any immediate gain, and we do so in a classic rollover fashion. We take those proceeds and deduct from the cost. But of course, we are now incurring cost in terms of those restoration, those repair costs. Those would be added in at this point, or when incurred, to establish on a future disposal, here it's of a painting, what then the full allowable cost would be. Have a little look through the answer to that, make sure you're happy with it before we move to the final part, and that is rather than merely damaging an asset, we're going to have outright destruction or loss of the asset. There is nothing that remains. So then it's a question of, is there or aren't there any insurance proceeds? Will there simply be a loss because we have lost that asset, it has been destroyed? Or will there be a gain based on any insurance proceeds that may be received? Okay, pause now, check through the answer to the one we've just done, then we'll come back and finish off this chapter. Okay then, let's deal now with the either outright destruction of or the loss of the asset. And again, it's a question of, is there any insurance money, any compensation that is received, or is there not? And then what do you do with it? Do you reinvest it, i.e. by, well, you've lost an asset that you presumably use within the business here, are you going to replace it? And therefore, do you spend the proceeds in acquiring a new one? And what we've got is a situation that we've seen before, and which we'll be looking at, in fact, in our next chapter here. And that is if you're basically disposing of one asset and replacing with another, then you may recall rollover relief was available so far as individuals, and as you'll see in the next chapter, also companies within corporate tax, as long as they were qualifying business assets for that purpose. Here, you're going to see an equivalent exercise dealing with rollover being performed based on how much of the insurance proceeds received, if there are any, have actually been reinvested in another asset there. Okay, what have we got? If an asset is destroyed or lost, and there are no compensations or insurance money, insurance proceeds, then a disposal will result in a capital loss. Well, of course it will. Sale proceeds zero, there's no compensation, there's no insurance money, less the allowable cost, that is your capital loss. Again, remember, no indexation allowance in relation to losses. Rather more likely in any exam question we see, because the first situation is way too simple, if there is any compensation or insurance monies received, this will normally be brought into an ordinary gains computation as proceeds. The date of the disposal is the date the insurance money is received. If the insurance money is used to buy a replacement asset, there's a time limit on this, within 12 months, then the gain can be deferred until the new asset is sold. Now, there's a little note here, but let's come to that in a moment. Let's look at example 6 to illustrate the points that we're now making here, and hopefully make it easier to follow. Calculate the chargeable gain and the base cost of the new asset. Right, it's a company, SC Limited, bought an asset, cost $23,000, June 2011. Again, we're interested in dates because of indexation allowance, of course, being available to companies. Destroyed in October 2018, insurance proceeds of $34,000 were received in March 19. Now that would be the disposal date. Of course now, whether you took the disposal date as being October 18, which it isn't, or when the insurance proceeds are received, that was March 19, and that is the disposal date. The only relevance of the date was for indexation allowance purposes. Given that indexation allowance is frozen at December 17, when those proceeds come in is irrelevant to the calculation of indexation allowance, presuming that this date, as it will be in any exam question you do, is post-December 17, because indexation is limited to it. There, of course, we are given the indexation factor to December 17. That we'll be using in establishing the bottom line chargeable gain. But to begin with, we've got ourselves a basic calculation of a gain. Don't worry about this bit at the moment, about the fact that then we spent 30,000 of the 34,000 insurance proceeds received in acquiring a replacement asset in June 2019. Just ignore that for one moment. Look upon this as it is a disposal. Basically, though it has been destroyed, you've sold it for tax purposes because you've got proceeds of 34,000. So what I want you to do is just a normal gains calculation where you're deemed to have sold it for your insurance proceeds of 34. There's that number. You have a cost of 23,000 incurred in June 2011. So you can compute firstly the unindexed gain, select your, we have already selected it, relevant indexation factor, applied to the allowable cost, and then deduct the indexation allowance in computing the chargeable gain. We'll then look at what happens given what then goes on to happen, that SC Limited spent 30,000 on a replacement asset in June 2019. But calculate, please, for the moment, the chargeable gain that would arise, subject to any deferral, subject indeed to, as we've called it, any rollover of the gain that arose on this deemed disposal. So pause now while you work that through, and then check that out with the answer in the back. Just down to the chargeable gain figure, I will then talk you through the rollover. Okay, let's review our answer to this, therefore. Now we know what the insurance proceeds are, 34,000. We have a cost of the asset of 23, so to all intents and purposes, this is a normal, simple gains calculation on a normal disposal using the insurance proceeds as your sale proceeds. We can then deduct indexation allowance based on the allowable cost figure, and therefore we get the chargeable gain, which is what I asked you to work to. It's a basic standard gains calculation when dealing with a corporate disposal of a chargeable asset. And now what happens? We had the insurance proceeds, and we have reinvested some, but not all of those proceeds, in acquiring a replacement asset there. Well, let's just make it easier. And let's think about what would have happened if all the £34,000 proceeds had indeed been reinvested in another replacement asset here. What that would mean is, like with rollover relief, which I hope you recall again from your CGT studies, and if you don't, make sure you revise that before you deal with the next chapter that looks at rollover relief, albeit just dealing with corporate tax now, of course. But if we reinvested all the sale proceeds, so if you took all the 34,000 and reinvested all of it in a replacement asset, then if you have full reinvestment, full rollover would be available, so all of that chargeable gain of 5,250 would be deferred. None of it would be taxable on the company now if we'd reinvested all 34,000. But we didn't. The question tells us that we bought the replacement asset for only £30,000. So proceeds have been used to buy a replacement asset, but only partially used. 34,000 proceeds, 30,000 reinvested, therefore 4,000, the part of the proceeds not reinvested, that part of the gain remains immediately chargeable. So you calculate, here the revise, it is the chargeable gain, the bit that is not eligible for rollover. And that bit, like with normal rollover relief, is that part of the proceeds that you have not reinvested. The sales proceeds 34, the reinvestment 30, you've taken out 4,000 on the deal, the company will be taxed on a gain of 4,000 this accounting period. 4,000 out of a gain of 5,250, therefore the balancing figure in there is a rollover of 1,250. That is the balancing figure. The gain was 5,250, of which 4,000 is immediately and will remain chargeable, leaving only 1,250 as being able to be deferred. What do you do, of course, with any rollover? You deduct it from the base cost of the newly acquired asset. We had bought for 30,000. The gain deferred, the rollover, is limited to 1,250. Therefore, the base cost of the new asset, 28,750, to use on its eventual disposal. So it is just like dealing with rollover relief. The question of, is it full deferral, the whole 5,250 being deferred? Why? Because you've reinvested all of the 34,000. Or if any part of that 34,000 has failed to be reinvested, here it is £4,000. That part of the gain remains fully chargeable, and only the balance, therefore, will be eligible for rollover. Whatever is the figure to be rolled over reduces the base cost of the newly acquired asset. Okay, Time, therefore, to finish off on this chapter. Again, make sure you've reviewed through and you're happy with the basis of the calculations there. You can then do, of course, the task set at the end of this chapter, as per usual, before then moving on, much as I think I have announced there, to dealing with the only capital gains tax relief that is applicable within corporate tax for chargeable gains purposes for companies, and that is rollover relief. Given what we've just seen, well, you've got a bit of a start into dealing with that particular issue. But again, would be worthwhile you going back and revising what we did in, well, that was back in chapter 14. But the only relief you need know about in terms of corporate tax is rollover. None of the other reliefs apply.